Hello, my dear students. A very warm welcome to all of you in Shri Jain Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we will continue with Chapter 2, that is Accounting Process, and we will begin with Unit 2, that is Ledger. All the concepts will be covered in the coming series of lectures. So let us begin. Let's begin with the introduction part. So we'll try to understand in this lecture what do we understand by the term ledger. So the first step in the accounting process is journalizing, that is journal. After making journal or after passing journal entries, the second step is ledger posting. Ledger posting means transfer of journal entries from journal to ledger. After recording the transaction in the journal, recorded entries are classified and grouped together. Students, what do we understand by the term classification over here? The term classify over here relates to ledger. We will classify and group the various transactions into certain ledgers. The books which contain all set of accounts, that is personal account, real account and nominal account. This is known as principal books of accounts, in which account wise balance of each account is determined. The next concept is meaning and significance of ledger. Why making ledger is so much important? So, as you all just understood, that ledger is an account book which contains all the heads of accounts which are opened in journal, that is subsidiary books. What is its importance? So, ledger helps to identify the list of transaction under particular account head. So, see for example, there are several debtors or there are so many credit customers. We are making sales to credit customers. So cash sales will be taken to cash account and credit sale will be taken to sales account. We will also make sundry debtors account. So we will group all the debtors together and we will put it under the head sundry debtors. Likewise, sundry creditors. So, ledger helps to identify the list of transactions under a particular account head and also shows the balances in each of the ledger accounts. This helps in ascertaining the status of that account. Status means closing figure or closing balance. Status could be the debtor had already paid all the amount. The debtor had already paid all the amount. So he is no longer a debtor. So he is no longer a debtor. That is credit customer. I believe it is making sense to you. Let's see an instance, that is an example. Cash account contains all the transactions involving cash. Hence, looking at the cash account, what we'll try to understand? Cash received and cash paid. It also shows the closing cash balance at the year end. So in cash account, we see all the receipts, receipts in cash, payments in cash, and closing cash balance. Is it clear till here? Let's move a bit. Let's move a bit ahead. Other names of ledger. So it is also known as principal book. That is, debit and credit aspect of each transaction is recorded here. Transaction example, purchase of inventory. When we will purchase the inventory, what would be the journal entry of purchasing inventory? Bank account debit. Sorry, purchase of journal entry would be purchase account debit and bank account credit. Okay. And constitutes the basis of preparation of trial balance and final accounts. Students, trial balance. Why we prepare trial balance? For checking the arithmetical accuracy. Arithmetical accuracy. Arithmetical accuracy means mathematical accuracy. And final accounts over here means income statement and statement of financial position. Statement of financial position. That is balance sheet. An income statement means profit and loss account. I believe I am making sense to all of you. So, the name of ledger could be principal book. It is also known as secondary book of entry. So, it is the second stage. The first stage is journalizing. This is the second stage in the accounting process. The third name is books of final entry. Students, you need to remember these names because it could be a part of MCQ. The ledger in the final destination of all transactions. So, all the transactions, what is the final destination? The final destination is ledger posting, that is ledger books. If you are clear till here, we could move ahead now. Source of ledger. What is the source of ledger? So the entries in the journal or subsidiary book from the basis of preparation of ledger. Students, you should understand source documents is the base or is the source for making journal entries, and journal entries will act as a base or act as a source for making ledger posting, ledger accounts. I believe it is clear. Without passing the entry in the journal or subsidiary books, an entry cannot appear in the ledger. Obviously, because it is the primary stage. The first stage is journalizing. This is the second stage. Stage 2, ledger posting. Transactions in the ledger are recorded in an analytical order. That means what? That as and when the transaction occurred, it would be recorded. As and when the transaction occurs in the business. it is to be recorded in the journal and then in the ledger. Let's move ahead with another topic, that is format of ledger accounts. Format of ledger accounts. What is the basic process? Number one, posting. That means what? After recording the transaction in the journal, that is known as journalizing. The debit and credit aspect of each of the journal entries is transferred to ledger account, where we will transfer it under the appropriate heads. We just shown you the heads: sales, purchases, cash, etc. This process is known as ledger posting or simply posting, that is transfer of entries from journal to ledger. The journal entries are classified and grouped appropriately under the specific heads. By preparation of accounts in the ledger under the specific heads, obviously. Let's see this format of ledger account very precisely. So we have debit side, credit side, model format of ledger account. This is the left side. Left side is known as debit side. Right side is known as credit side. This is account, example cash account. This could be cash account. The opening balance, cash account is an asset. So the nature of account is debit. So opening balance would be here. Then there would be various receipts, transactions. All receipts will be recorded here. Then payments over here, receipts. Over here, payments. In case of cash accounts, all the payments will be recorded here. Supposingly the total balance over here is 20,000. We will transfer 20,000 over here, and the accumulation of these accounts is 15,000. So this 5,000 over here will act as a closing balance. Will act as a closing balance, and we will write what? Closing balance by balance carried down. That is the closing balance. And opening balance, what we will write? To balance brought down. I hope we are clear till here. Let's move ahead. Description of format of ledger accounts. So separate account is opened in the ledger book for each type of account, that is capital, loan, machinery, furniture, sales, purchases, rent, salary, commission, electricity, discount received, etc. Every ledger account has two sides. Left hand side, that is debit side, and right hand side, that is credit side. The ledger posting is done based on account to be debited and credited as per the journal entry. So as per the journal entry, we understand where to debit and where to credit, what to debit and what to credit. If it is on the debit side, that is left hand side, debit side or left hand side, it is to be prefixed by the word to. And if it is on the right side, that is credit side, it is to be prefixed by the word by. On the right side, it is prefixed by the word by. The column, that is journal folio, is used to indicate the page number. Students, we have written journal entry in journal book, and from this journal entry we are passing what? Ledger. These two, this is step 1, a journal book, this is different. This is step 2, ledger, this is different. So while making the ledger, we will give references to journal, and that is known as journal folio number. Journal folio number. I believe I'm making sense to you. In the journal book where the relevant journal entry is found. This is used to track and trace the entry in the journal book. So supposingly, if auditor wants to check the ledger posting and he want to see the source document, the auditor should not visit all the books in journal or all the pages. He should just see the folio number, open that page, and he should directly go to that folio number and check it. This will lead to time saving of time and better clarity. Better clarity. Opening balance will be written on the left hand side for debit balances accounts. Over here, debit balances account means the accounts where the nature of the accounts is debit balance. It will be written on the credit side where the nature of the account is credit balance. I'll quote an example over here. If it is an asset, all the assets have debit balance. If it is a liability, all the liabilities have credit balance. So accordingly, it is to be shown. The ledger accounts are broadly classified into assets, liabilities, incomes, and expenses. Dear students, all assets have debit balance, all liabilities have credit balance, all incomes have credit balance, and all expenses have debit balance. You know, income and expenses, it is a part of nominal account where the rule is debit all expenses and losses. Credit all incomes and gains. So over here, we have to debit all the expenses and we have to credit if it is an income. Is it clear till here? Let's move ahead now. The next concept is posting of journal entries to ledger accounts. What are the guidelines we need to follow? The following steps are involved in the posting of general entries to ledger accounts. While making the posting of journal entries, we need to understand, we need to take care these things. Number one, what is the steps? We should identify what accounts to be debited and what accounts to be credited in the journal entry. Step 2, if the account is debited in the journal entry, this implies that under the ledger account, it will be specifically opened for that item. The accountant has to write on the debit side of ledger account what he will write: to as prefix and name of account. If on the credit side it is to be written, then prefixed by and name of account. I'll quote an example, students. Supposingly, we made a purchase, credit purchase. The journal entry would be purchase account debited and we paid in bank. So, purchase account debited and to bank. While making the ledger posting, how we'll be doing? Just see it over here. I'm making a small account over here, the ledger posting. This is an purchase account. This is bank account. So, purchase account debit to bank. Over here, purchase account debit. On the debit side, we will write what? So this is the proper format. Purchase account debit to bank. Over here we will write the amount. And in bank we will write by purchases. We will be writing the amount over here. I believe all of you must have understood till here. Let's move ahead to step number 3 that talks about all the journal entries are periodically posted to the ledger account from the journal book. Journal book is step 1. Periodically posting to ledger account is step 2. Thus, a ledger account may consist of entries on both the sides of the account. I just shown you over here, my dear students. Both the side, debit side we have bank and credit side we have purchases in different accounts. Supposingly, if I talk about purchase account, debit side we have bank and credit side we will have some different entries. Okay? Note, where an account is already present in the ledger, the journal entry should be updated in the ledger account itself. If it does not exist, then fresh account to be opened in the ledger book. So supposingly, we have 10 entries in case of purchases. We have 10 entries in case of purchases. That does not mean that for 10 times we will be opening the purchase account. Example, purchase account 1, purchase account 2, purchase account 3 and so on. So this is a wrong terminology. Purchase account 1, purchase account 2, purchase account 3. Likewise, we should not do it. What we will do it in that case? We will just open an account known as purchase account and we will record all the purchases made over here. I believe I am making sense to you. This is clear. Let's move ahead. Let's learn how we are going to balance an account. This is going to be very interesting. So to ascertain the balance of an account, what needs to be done? Supposingly, I want to balance this purchase account. So I'll be writing some hypothetical figure over here, 1000, 1000, 3000. Then on credit side, I had written 2000 and 1000 students. First of all, we should see then which side, that is debit side or credit side, the totals are more or totals are big. So 3 plus 2 equals 5 over here and 2 plus 1 equals 3. So the bigger total is 5. This total is only 3000. So 5000 and 3000, the bigger total is 5000. This 2000 is balancing figure. This 2000 is left over here. This is known as balancing figure. That is closing balance. We will be writing by balance carried down. That is the closing balance of purchase account by balance carried down. Is it clear? Okay. I hope you understood how we are going to balance a ledger account. Over here I had quoted an example of purchase account, how to balance a purchase account. First of all, what we will do, we will write the debit figures and the credit figures, the amount that is in rupee. We'll total it both the side. So one side is 5,000, one side is 3,000. We'll be writing the bigger total, that is 5,000 and 3,000. So bigger total is 5,000. Then over here there is a less fund, so balancing figure will be coming on the credit side. Dear students, if someone will ask you what is the account of or what is the balance of purchase account over here, you will be answering, sir, purchase account is having debit balance. Why? Because the debit side total is more, and that is why you got the balancing figure on the credit side. So this balancing figure on the credit side denotes debit balance. This is the way you can understand this. Otherwise, you just see the total is bigger on the debit side, so purchase account is having debit balance. We should take one more example over here. Let's take one more example over here. Sales account. Suppose on the debit side, the balances is 200, 100, 300. On the credit side, the balances is 500 and 100. That is 600. And 200. So first of all, we had recorded the amount on both the side. We will total now 2, 3, 6, 600, 5, 6, 7, 8, 800. So the bigger total is 800. We'll be writing 800. The balancing figure is on the debit side, that is 200. So we will write over here to balance carried down. That is the closing balance of sales account. To balance carried down. So students, you had seen in purchase account, we got the balancing figure on the credit side. That denotes debit balance. Why? Because the debit side total is more. In sales account, the balancing figure is on debit side. That denotes credit balance. Credit balance because the credit side's total is more. That is 800. I feel I'm making sense to all of you. You are understanding it well. Let's move ahead. We had learnt this balancing of accounts. These concepts are already discussed. Let's see an illustration now. This is a beautiful illustration. I think it is going to be fun. Following are the transactions in the book of a trader. The debit balance on January 1, 2006. Cash in hand 8,000. Cash at bank 25,000. Stock of goods 20,000. Building is 10,000. Daters we have Vijay and Madhu. Vijay 2,000 and Madhu 2,000. Credit balance on January 1, 2006. My dear students, this was debit balance. Now see the credit balance. Sundry creditors Anand, that is 5,000. Following were the transactions took place in the month of January 2006. January 1. Purchases goods worth 5,000 for cash less 20% trade discount and 5% cash discount. What we need to do it over here? First, is the trade discount, and then we have cash discounts. Trade discount is a discount on bargaining. Discount taken at the time of purchase. I'll quote an example over here. Supposingly, you bought a product, the MRP of the product is 10,000. The shopkeeper said that, sir, this product is of 10,000. You should pay 10,000. You did a little bargain and the shopkeeper was ready to offer you this product at 9,000. That is at 10% discount, my dear students. This is known as trade discount, this amount of 1,000. This is your skill that you bargained it well and you finalize the amount at 9,000. You should understand it over here that shopkeeper will make a bill for rupees 9,000 and not 10,000. But what is cash discount? So cash discount is the discount offered to the debtor, to the credit customer for making prompt payment. Making prompt payment. Let's see this example further. So over here, you had made sales of, you had bought this product at 9,000 and the shopkeeper had made you a sale of 9,000. The shopkeeper allowed you 3-month credit and told you that, sir, you make this payment after 3 months. You are like, fine, okay, there is no problem. After 3-4 days, you received a call from the shopkeeper and he said, sir, I want to offer you a further discount of 5%. You will be asking the shopkeeper, sir, why you are so generous? Why you want to offer a discount of 5%? He'll tell you that, sir, if you will make me a quick prompt payment, I will be offering you a cash discount at the rate 5%. So 5% of 9,000 is 450. That means what? If you made the payment, if you make the payment of 450, in that case, you had bought this good at 8,550. My dear students, we'll be recording 9,000 as purchases made, and after the purchases we had, after we make the purchases, for making prompt payment, early payment, that shopkeeper had allowed us 450 discount. So this 450 will find place in the books of accounts, will be recorded, but this 1,000 will not be recorded because this is the bargain discount. I believe you understood it well. Let's move ahead. On January 4, we received 1980 from Vijay. Who is Vijay? Vijay is our debtor. So we could have received 2,000 from Vijay, but we have received only 1980. But we had allowed him 20 as discount, so it's fine. January 8, we had purchased plant from Mukesh for 5,000 and paid 100 as cartage for bringing the plant to the factory. So 5,000 plus cartage, this could be 5,100, and another 200 as installation charges. That means this would be 5,000 plus 100 plus this 200. Is it clear to all of you? Sold goods to Rahim on credit. January 12, sold goods to Rahim on credit, 600. Fine. January 15, Rahim became insolvent and could pay only 50 paisa in a rupee. 50 paisa in a rupee there is 100 paisa. He paid 50 paisa. That means he paid 50%. We need to receive 600 from Rahim, so he will pay 50% of 300, 600, that is 300. So 50% of 600 equal to rupee 300. Rahim became insolvent. Okay. On January 18, sold goods to Ram for cash, that is 1000. Sold goods to Ram for cash, that is 1000. What we need to prepare? We need to prepare cash account and we need to prepare bank account. We only need to prepare cash account and bank account. The whole question is there on your screen right now. Let us prepare cash and bank account. This is the format of cash account. Draw along with me. Date, particulars, journal folio, amount. Amount is it is to be in rupees. On the credit side we have date, particulars, journal folio, amount in terms of rupees. I had denoted debit side as debit, left side as debit, and right side as credit. Let us begin from opening. Let's see, this is in cash account, so let's check the opening of cash account. Cash in hand 8,000, cash at bank 25,000. We'll make bank account later on. First we are preparing cash account. So on January 1, the opening balance, that is to balance, brought down. The opening balance was 8,000. Then just see this first journal entry. Purchase goods worth 5,000 for 20% trade discount and 5% cash discount. 20% cash discount and 5%, 20% trade discount and 5% cash discount. Students, what would be the journal entry? Purchases. So you see it over here, 5,000 minus 20%. 20% of 5,000 is 1,000. That means we will record it at 4,000. But from this 4,000, 5% is trade discount. That is minus 200. So this purchase is of actual nature, that is of 3,800. I believe it is clear how we reach to 3,800. So January 1 by purchases 3,800. Let's see the entry on January 4. Received 1980 from Vijay and offered 20% discount. What we received? 1980. Who given us? Vijay. So to Vijay. The date is January 4. Let's move ahead. On January 8, purchased a plant from Mukesh for 5,000 and paid 100 as cartage for bringing the plant to factory. This 100 would be in cash because it is cartage, and another 200 as installation charges. We assume it as payment of cash, right? So we will record it as 200 and 100, that is 300 we will be recording in cash. And generally, how we will be recording it as, over here it will be January 8 by plant 300. Let's see January 12. Sold goods to Rahim on credit 600. Because this is a credit transaction, we will not be making the entry. January 15, Rahim became insolvent and paid 50 paisa. That means 50% of 600, that means 300. So on January 15, we have received from Rahim 300, that is 600 multiplied by 50%. I believe you are clear till here. Sold goods to Ram for cash 1000. We sold goods to Ram and received 1000 as cash. So January 18, to sales account 1000. See, this is cash, so we'll be writing sales account. This is not a credit transaction. Students, we had taken an assumption over here that purchase of plant from Mukesh of 5,000, this is of credit transaction. This is in credit in nature, but we had paid the cartage expenses and installation expenses in cash, and that is why we took over here only 3,000. If the whole is paid in cash, then over here it would be 5,300. I believe you are clear with this. So we had taken an assumption over here on January 8 that the plant and machinery purchased from Mukesh, that is of 5,000, is a credit transaction. I believe I'm making sense to you. Let's do the totals. 8,000, 9,000, 10,000, 11,280. The larger total will be taken over here from debit side to credit side. Let's deduct these two amounts from this total. 11,280 minus 3,800 minus 300, and the balancing figure is 7,180. Buy balance carried down. That means closing balance of cash. Closing cash balance. I believe it is clear till over here. Let us make the bank account as required in the question. Let us draw bank account. Debit side, credit side, date, particulars, journal folio, amount, date, particulars, journal folio, and amount. Kindly give heading along with me. Amount would be in rupees. Let's see the opening balance of bank account. My dear students, the opening balance of bank account is 25,000. So we will record on the debit side, that is January 1, to balance brought down 25,000. We don't have any entries in relation to that, so we will close it 25,000. We'll take this 25,000 to the credit side. The balancing figure would be 25,000. It will be written as by balance carried down, that is closing bank balance. This closing bank balance will be act as a opening bank balance in February. So on February 1, it will be to balance brought down. And this figure will shift from here to here, that is 25,000. Same in the cash account, the similar action will happen, that is February 1, dated February 1, we'll be writing to balance brought down. We will be transferring the amount from the credit side to debit side, that is 7,180. I hope it is clear. Students, I believe you had done till here. Let us conclude this lecture till here only. Thank you very much. Thank you, all of you.